Hi, this is J.R. Fibonacci, and this video presentation is called The Domino Effect and the Collapse of the Baby Boom Bubbles. So the interesting thing that distinguishes this video from some of the others that I have made is a few simple graphics showing some dominoes from 1 to 6 starting to fall over. And the logical sequence from one domino to the next is pretty easy to understand. So I'm going to briefly go through a few images that are linked. If you're watching this off of YouTube, you can go to my WordPress blog, jrfibonacci.wordpress.com, and find the domino effect in the collapse of the baby boom bubbles. And see the pictures there. So that first picture, it's oil prices, then gas prices, then expenses, then surplus cash, or the amount of cash left over after expenses, and then investing and lending, and finally, number 6, prices of real estate and stocks and so forth. So I'm going to review these 3 images and the content within them. There's a little bit of extra information, or 2 other images that I will also mention. And watching this video will allow for you to understand what's been going on for quite a while that surprised a lot of people. Myself and many other researchers were not surprised by these things, these stack of dominoes falling. Jimmy Carter, President of the United States in the late 70s, specifically referred to many of these same dominoes, so to speak, many of these same developments coming in a sequence of time, and we are simply later down the sequence than we as a nation or as humanity were in the late 70s. And with this time of unprecedented change comes unprecedented opportunity. Many people view what's been going on in the last few years in parts of Europe and North America as a crisis, and that's certainly a very valid interpretation and experience of what's been going on. But there's also tremendous opportunity, and I'll say a little bit about that. There's also some big instabilities, or increasing instabilities, increasing risks, or increasing recognition of risks that have been there all along. And so one of the things that I do is offer people sheltering services where they can shelter their investments and revenues and business activities and finances from courts as well as tax liability, with the full protection of courts, but also protected from certain kinds of court action. So that's a little background to why I'm presenting this information. It's not just for your education, it's also because I'm confident that you may be interested in my assistance with adapting to some developments that are relatively easy to understand and predict. In 2004, I published The Real U.S. Deficit Oil. In 2005, Worth Its Weight in Oil. And this content really isn't much different than those in the 2004 articles when I first used the term the domino effect. And I just have some new images and a new video. Back to that first image. Oil prices, as they go up or down, that's going to influence the price of gasoline. Oil prices, if you look below that first image of dominoes, you'll see oil prices in the U.S. for several decades, and you can see that the oil prices were generally going down decade after decade, and that's largely because it was getting cheaper and cheaper to get the oil out of the ground with improvements in technology, a particular technology of computers that wasn't very prominent in the 1940s or 1910s, was very prominent in the 1980s and 1990s and made huge advances in improvements or decreases in the expense of actually extracting and refining and distributing oil. Even finding oil got cheaper. There just wasn't much oil to find as of that point. So oil prices were going down, and you can also see in the chart below that inflation-adjusted prices of gas in the U.S. also declined decade after decade throughout most of the 20th century, with the notable exception of the 1970s. But really, that's just a little blip. The overall trend is clearly down, and that means that given what a U.S. dollar could purchase of a variety of things, the actual inflation-adjusted expense of a gallon of gas was decreasing overall decade after decade in the U.S. So as oil prices rise, gasoline prices rise, because gasoline is refined from oil. And as gasoline prices rise, expenses rise for households, for people everywhere, including businesses, including governments, militaries, churches, artists, soldiers, merchants, truckers, farmers, whatever it may be. Expenses go up depending on how much people have been spending on gasoline or fuel. So as expenses go up, as costs go up, then the surplus cash goes down. The net profits go down. The net revenues go down. The amount of money left to spend goes down because it's being spent on gas at the pump, at the gas station. So when surplus cash is going down for all these people and these organizations of people, then those people and groups of people invest less in things like stock markets. And they lend less because they have less cash to lend, so there's less lending. And when there's less investing and less lending, then that means that there's less buying of stocks, there's less buying of real estate. Especially in the case of real estate, since real estate has been so dependent on financing, on lending, in order to purchase real estate, with people putting 95% down and financing 95% of their purchases, only putting 5% down, and financing 99% of their purchases, only putting 1% down. So real estate has really been affected quite a bit from a decrease in lending. And that decrease in lending, if you just go backwards to the dominoes, the decrease in lending is related to less cash available to lend. Less cash is a result of more expenses on fuel, and that expenses on fuel is from rising prices of gas and rising prices of oil. Oil has been rising worldwide in price since 1999, with some exceptions. There was a big decline in 2008 after oil prices neared $148 per barrel. At that time, in parts of Europe, a price of a gallon of gasoline was $10 or $11. In parts of the U.S., it was over $4. So prices are down a little bit for fuel, for gasoline right now, but I'm suggesting, as we get to the later charts, that the overall trend of rising oil and gas prices is very likely to continue, with the resulting effects of, as I was just saying, prices of stocks and real estate dropping because there's less money, less surplus money for investing and lending. So those are the baby boom bubbles: stock prices, real estate prices, but also things like lots and lots of agriculture and lots of human population. The baby boom itself is a huge surge in population of humanity. I'm assuming people are familiar with the baby boom, but basically when there were soldiers in World War II from Europe and North America and also other parts of the world like Japan, and those soldiers stopped fighting and the war ended and they went home and people started to procreate or reproduce, have children more. You had a surge in the birth rate, so it caused what's called the baby boom. So there was a big surge in population. At that time, in the mid-1940s, there was abundant oil. It was getting cheaper and cheaper, decade after decade. the U.S. was still increasing its production of oil every year. It hadn't got to its peak in production in 1970 yet. So I already made reference to the decline in inflation-adjusted prices of oil and gas over the decades of the 20th century overall. So what happened in 1999? Well, that caused oil prices to begin to rise dramatically. Basically, demand was surging much faster than supply was increasing. Supplies were still increasing in 1999, 2000, 2001. There was still more production of oil than prior years, but demand was increasing much faster than supplies, than production. And as of 2006, production of oil globally peaked and has steadied and haven't really declined much since 2006, but 2006 may have been the all-time high in oil production worldwide, and that will accelerate in its decline probably until there are sharp drops year after year and decade after decade in oil production until there's negligible or zero oil production. The same basic thing for coal and natural gas and other fossil fuels. So now onto that second series of dominoes. These are not the shaded dominoes, but with the really small words, and then there's the green words begins in the first four, and then the red words peaks in the last two. That's in relation to oil in particular. This is a simple sequence. This is part of what Jimmy Carter was referring to. You have exploration of oil start, then as exploration starting and rises, you have discovery of oil reserves rising, beginning and then rising. Extraction and refinement of oil begins and rises. Consumption of the oil that's been refined begins and rises. But then exploration peaks, which happened in the U.S. I think in the 1930s or 1940s, and then discovery of oil peaks because exploration's peaking. The more exploration there is, the more oil is found. But then at a certain point, you've explored most everywhere there is to explore, and so you don't find as much oil as you had, say, in the 1920s or 1890s. So discovery peaks in each individual place, like Russia or the U.S. or Saudi Arabia, and then on the whole worldwide it peaks at some point. And then production or extraction and refinement of oil peaks and drops. And of course consumption of oil peaks and drops. So demand for oil continues to rise potentially, even as the availability or supply of oil is flattening and then dropping really fast. Demand can actually rise very, very quickly, and apparently that's what happened starting around 1999 as oil prices went from $11 a barrel to $148 a barrel in 9 years or so. Production of oil peaked in the U.S. around 1970, but in other parts of the world, production was still increasing all the way through 2006, the global peak, apparently, of oil production. So, again, that increasing supply plus the improvements in technology of extracting oil allowed for oil prices to decrease, even in the U.S., and gasoline prices from 1980 till 1999 and beyond. Gasoline prices in inflation-adjusted terms dropped ongoingly throughout those decades. I'm going to move on for now. I can make references to other places like Japan or Venezuela, which have very different timing. They have the same sequence, but different points in time when they reach the different dominoes, right? So Japan peaked in 1989 and has been in a economic decline since then. The Soviet Union actually dissolved or collapsed in the late 1980s, even though in the 20th century overall, the US and USSR became superpowers because they had so much oil. The number 1 and 2 producers of oil in the 20th century were the US and the USSR. And then Saudi Arabia later became close to the amount of oil production that we'd seen in US and USSR. Let's just move on. I'll let you kind of sort some of this stuff out, think about it, and then you can talk to me if you'd like as far as how to actually adapt in your own finances, your own investing, and other choices. But let's look at this last sequence of 6. It's kind of the summary of the whole thing. Oil and gas prices get cheaper and cheaper. That's number 1. That was from 1870 to 1999, generally speaking. Oil price and gas price are all that more than 100-year period. So that resulted, that cheap fuel resulted in certain economies, certain industries, certain kinds of things that prospered based on cheap fuel. Those parts of the world, those economies, those industries boomed. That's part of the baby boom bubble. Lending and borrowing rocketed. Human population rocketed in the last 200 years. Huge increase. But going to number 3, as of 1999, oil prices began that rise of 1,200% in 9 years, up till 2008. I saw that coming in 2004 and 2005 and published articles about it. Many other people did too. So as those prices spiked, getting back to my first sequence, my first dominoes, as the gas and oil prices spike, that means more costs, more expenses. That means less surplus cash for people, including groups of people, organizations, businesses, governments. Less investing and less lending because they have less cash to invest and less cash to lend, they being us. And that leads to domino 4 here. Real estate and stock prices drop very quickly, also known as collapse. It happened in USSR, happened in Japan, it happened in the UK, Ireland, Greece, various places, and it's happened also in the US and other parts of the world too. So number 5, many face bankruptcy and foreclosure. Those who've been the most aggressive borrowers and speculators and gamblers. They are facing some consequences from these predictable events of fuel prices rising. Whoa, some of these businesses aren't able to do so well. Enron goes bankrupt. AIG, Merrill Lynch, Bear Stearns, Countrywide, Bank of America face some issues with their solvency, and I'm just naming some U.S. companies. Of course, in Japan and all over Europe, there were other industries and companies that have had issues. The government of Greece, the government of Ireland, the government of New Jersey and of California. Lots of budget issues and the capacity of those governments to pay back their debts to whoever has lent them money or bought the bonds of those governments. So governments, private businesses, and individuals are facing bankruptcy and foreclosure. The more organizations and people facing bankruptcy, the less likely anyone else is going to get the full amount of the debt owed to them repaid. So it becomes this really snowball effect kind of situation. So that's domino 5. Many face bankruptcy and foreclosure. But that leads to what I mentioned before, a tremendous opportunity. So there's lots of wealth spread out throughout lots of people, but those people are getting desperate for cash. They're trying to avoid bankruptcy. They're trying to avoid foreclosure. Governments, businesses, households, they're all desperate, or many of them are increasingly desperate to get cash. That means they're selling real estate, stocks, even silver, gold, laptop computers, carpet. You see, I drive down the street, not only do I see lots of for sale signs on real estate, but I see lots of 50% off sale signs, 25% off sale signs. Lots of businesses are doing liquidation sales for 3 years running. So That's an opportunity. Prudent investors, people who saw what was coming early and who are willing to adapt quickly, even if they just see it, as I'm watching this video. If you just get it now, and before most people do, you sell your real estate and your stocks, then you avoid all the tremendous risk and the tremendous risk of decline in those investments as gas prices rise and this whole sequence of dominoes falls. You avoid that risk and you actually have an opportunity available. I'm not going to detail what investments do extremely well as oil and gas prices rise, and it's not actually just as simple as oil wells. You might think, oh, oil wells. Well, that's possible, but that's not guaranteed either. Oil wells where? There are some very easy, very simple things that people can do that are easily available that are tremendous profit opportunities, as well as simple precautions that people can take to shelter their finances from creditors, from courts, from tax collectors. We can expect, as governments become increasingly desperate, that they might raise tax rates tremendously, that we might find lawsuits increasing. We might find disputes between contracts increasing. We see, for instance, that insurance companies who are liable for covering mortgages when borrowers default, those insurance companies are having disputes with the lenders. Bank of America and AIG, for instance, are in lawsuits trying to figure out how to resolve these liabilities that these insurance companies have, because they don't have the money to pay all those liabilities in many cases. So their lawyers are trying to reduce the amount of money that goes out to the lenders. Bankruptcy court trustees, bankruptcy court judges are resolving some of these issues, but it's a negotiation process. So people who are outside of that whole range of risk, who are going to safe investments, or who are going to investments that are dramatically increasing in value, they are receiving this huge amount of wealth as the middle classes and baby boomers are allowing their wealth to fall to other ownership. Some people are receiving that affluence. There's a tremendous concentration of wealth happening. There's an unprecedented opportunity from noticing quickly what's going on and then adapting promptly and prudently, and then investing prudently to benefit from the changes developing, the changes emerging, easily predicted changes, easy gains, as well as the capacity with all of this prosperity that's changing hands, the capacity to influence the future development of humanity, of society, of governments, of politics, of technology, of research, of innovation, of the technologies that will replace fossil fuels. And there's an immense opportunity available. So if you are interested in participating in the ongoing adaptation and participating early so that you benefit as well as avoid losses, so that you would benefit tremendously, then please contact me. I look forward to assisting you in being clear about what's happening and adapting in a way that fits for you, because it's not exactly the same for any particular business or individual what's going to be the best adjustments to make. But there are some obvious things anybody can do on their own in terms of precautions, but exactly what are the best for you, and what are the best adjustments for you, and what are the opportunities that are available. I suggest you might find it very valuable to talk to someone like myself, who has understood these things and predicted them, who wrote about them in 2004, 2005, 2003, and who are also paying attention to the investments that are doing very well. Very well. There was a stock market sector that is now up. I think it's over 1,600% since late 2000. A U.S. stock sector of 15 companies. It's HUI. I don't recommend it now, but I mention it because it gives an indication of what most people have been missing in the last several years. That stock sector, if you just bought it in late 2000 and sold it, yesterday, so the end of 2010, there's about a 1,600% increase. So most people aren't aware of that kind of opportunity. But you can check it out. I made reference to that sector in my March 2003 publication. So I look forward to hearing from you. I look forward to working with you and benefiting with you. And I appreciate your attention and your interest